Welcome to the 2021 ALMA Convention and the Commission's Low-Income Housing Tax Credit, Income and Asset Verifications and Calculations session. This session will be presented by myself, Lana K. Lipp, Sarah Watson, our newest portfolio analyst, Shauna Higgins, and Dwayne Bakke, who is acting as our technician for this session. A couple of notes regarding this Pathables presentation. Poll questions are posted for you in Pathables to answer as we go through the presentation. We ask that you please post any questions in the Pathables chat, and we will answer those questions at the end of the presentation. Theater mode is the best vehicle to view our presentation slides. On our agenda for today is to review employment verifications and then check on calculations from those verifications. Sarah will then walk you through the Commission's work number rules and take a look at sample work number verifications. She's then going to look at the online portal for unemployment verifications. Shauna is going to review how to document gig income. Then she's going to take a look at annuities and whether they should be considered an asset or income. And then I'm going to review verification of deposits. Again, when we're done with this agenda, we will then take up your questions that you've put in chat through the presentation. Before we jump into any verifications, we do want to remind you of the need for due diligence and to double check all of your verifications. Verifications need to be clear and complete. All questions must be answered on verification forms. All information must be provided to calculate income or value assets and calculate annual earnings. You should obtain clarifications where needed. And you should also question inconsistencies and document the file with explanations from either third party or from the resident. Alternate forms of verification are acceptable when no response to 3 documented attempts over a 2-week period can be obtained. When a verification does not provide all necessary information, for example, you may need to include a pay stub to answer any questions that aren't clear on the employment verification. And there are also times when there is no third-party direct verification source to send a verification request to, such as with gig work, which Shauna is going to cover, that is normally treated as self-employment, or with casual earnings. So let's take a look at a first employment verification. The complete verification is currently on your screen, but I am going to blow up just the section where the verified information is so that we can get a little better look at it. We can see we have a start date. We have hourly wages plus tips, they're telling us. We have 31 hours a week. We have a year-to-date amount and a from and through period. Overtime rate is listed, however, no overtime hours were declared. No shift differential. There is a commission, bonus, or tip amount, which is included in the year-to-date and looks to be paid bi-weekly. And then we can also see that effective January 1, 2021, a 25-cent raise was listed. So given this information, what we want to do is look at what would you count for a 9/1/2020 move-in date. And we're going to take a look at that together. The first thing we need to do is remember that there is a raise involved with this calculation. So we want to figure out how much time before the raise and then after the raise. So if the move-in date is 9/1 and the raise is going to be effective January 1, 2021, that tells us we need to first look at what is the period between 9/1 and 12/31 at the current rate. This insert is from timeanddate.com. This is their date-to-date calculator function. In order to use this function, you put in the start date of your period, the end date to your period, and don't forget to check this box so that all the days, including 9/1 and 12/31, are included in the calculation. Once you do this and hit calculate duration, it will give you the number of days, and then will also give you alternate time units, including the number of weeks. Here, they're calculating 17 weeks and 3 days. When I'm calculating for the period of time before a raise, I would just use the full 17 weeks. However, you could look at it as 122 days divided by the 7 for 17.43 weeks. But again, I'm going to round down to 17. So we have $14.50 per hour times 31 hours per week times 17 weeks to give us how much money will be earned before the anticipated raise. We're then going to look at after the raise. So 52 weeks in the year or in the certification period, less the 17 weeks before the raise, means there's going to be 35 weeks after the raise. We're going to use $14.75, which is the $14.50 an hour original rate plus the 25-cent raise, times 31 hours a week, times 35 weeks. So that tells us after the raise, the anticipated income. Next, we need to factor in those tips. So although we don't have an hourly tip amount, we were told that between 2/24 and 8/12, the year-to-date period, and that is 171 days divided by 7, so 24.43 weeks, that during that period, $2,380 was earned in tips. If we take that tip amount, divide it by the number of weeks, and again, here you could round down to 24 weeks, but because this is a very specific period, we will allow for a fractional period when you're calculating how many weeks are included in that year to date. And then we're going to take that times 52, and that'll tell us what we expect to see in tips for the annualized period. We'll then take the income anticipated before the raise, plus that after the raise, plus the annual tip amount for a total of $28,711.15. Of course, we also need to look at our annualized year-to-date calculation. So if we take the $8,028, the full year-to-date amount, not just the tips, we're going to divide again by that same 24.43 weeks that we established when we looked at the tips. And we're going to multiply that by 52. That will give us the annualized year to date. There's that 25-cent raise, 31 hours per week, times the 35 weeks after the raise. So that's the amount that's expected for a raise. And then we can add those two together for a total annualized year-to-date plus anticipated tips. Once we get to this point, we can then look at how we would show that information on our Household Eligibility Certification, or our HEC. We'd show a line for the amount before the raise, a line for the amount after the raise, and then we want to show in those annualized tips and add that all together. We would then drop down to the year-to-date section, calculate the year-to-date earnings, and then add in that raise amount. However, the other thing that we would want to do on this verification is say, is there anything that might need to be clarified? Especially based on that differentiation in income that we calculated, 28,000 versus 17,000. You might want to look back at the resident eligibility application and see what the applicant or resident anticipated for their annual wages, because this is quite a difference. It's over $11,000 in difference. So when you see something like this, it might very well be worth asking the employer about that large difference. And that's what was done in this case. So on this next slide, we have the same employment verification. This was sent back to the owner, asked for a clarification, and when it came back, they added a piece of information, which was that Ethan was laid off between 3/24 and 6/6 of 2020 due to the pandemic. So what that tells us is that year to date doesn't include all of those weeks between 2/24 and 8/12 because he was laid off for a period of time. So let's relook at our calculation. The part about before the raise and after the raise, that is still good. But what we need to relook at is those annualized tips and those annualized earnings. From 2/24 to 3/23, and then from 6/6 to 8/12, that'll give us the period of time in that year to date when the employee was actually working. And that is 97 days or 13.86 weeks instead of the 24.43 weeks if it would have been from 2/24 all the way through 8/12 without the layoff period. So now we're going to look at that tip amount year to date, and we're going to divide it by 13.86 weeks times 52, and we're going to get a much higher annualized amount of $8,929.29. So again, we're going to add anticipated income before the raise, after the raise, plus the tip amount, and we're going to get a higher calculation than what we had before. With the year to date, we're also going to now use that 13.86 weeks that we established when we were looking at the tip period to factor out the time when the resident was laid off. And we're going to multiply that times 52 for a higher annualized earnings. Again, we're going to add the raise amount into that for a total of $30,390. Now we have two calculations that are much more in line. This additional information about the layoff period added $3,863.39 in income, and it actually changed the household from being qualified to being overqualified. So you want to please make sure to review all information on verifications carefully and seek clarification when things don't seem to add up. Now we're going to look at some additional things to watch for on employment verifications. And for these, I'm just going to show you the real meat of the verified information. So here we have an individual and their verification that was received, and we want to look for what needs clarification. The first thing I notice is the frequency of the pay is a little off. So they put over 42,000 and they said that's biweekly. So the chances are this person doesn't make 42,000 biweekly. 42,000 is probably the annual amount, and they're probably paid biweekly. But that is something that we would want to get clarification on. The other thing I see is the start of the year-to-date period. This person was first employed on 3/7/2017, but yet their year-to-date in 2020 started from 4/27 to 5/10. They're saying that's 10 pay periods, which would probably make sense because they've already made over $18,000. So we would definitely need to clarify that. Then there's the question of commission, bonuses, tips, and other. It says NA, but yet it says it's included in the year-to-date figure above. In addition, on the residence eligibility application, they also said that they received bonuses. So definitely something that we would want to seek clarification on. The other item that I notice here is that the employer says the employee participates in a 401k retirement account, and you would just want to make sure that you look at the resident eligibility application to see if that 401k account was declared and if you have valued it, and if perhaps you might need to get a verification on that account. So let's get a phone clarification. They received some additional information. So yes, they verified that the pay listed of $42,000 is actually yearly and not paid out biweekly. They have a new information as far as the year-to-date period. So now it says it starts 12/23/2019. However, we also have a different ending date now. It was 5/10, now we have 5/17. And we also know that the commission, tips, or bonuses, $1,050 is paid quarterly. It is included in the year to date, and just a little additional information that the average bonus is $1,050 per quarter, dependent on performance. Okay, and the verified salary is the annual amount, and year to date started 12/23 through the end of pay period 5/17. So what's still perhaps unclear with this clarification? The year-to-date period now has a new ending date. Is that the end of the pay period, or is it the actual pay date? We'll need to figure that out to be able to figure out how many weeks to include in that year-to-date period. There's also the question of how many quarterly bonuses, or what is the total bonus amount included in the year to date, as that might factor in. There could be, with this being a May, basically year to date, there could be, if they were paid quarterly, maybe they got a quarterly bonus in March. But maybe this includes, since it started December 23rd, maybe it includes 2 bonus periods, one that was paid out at the end of December, and maybe one at the end of March or beginning of April. So those are some things that still aren't crystal clear with this verification. When I received this verification in, I saw that the property used 12/23/19 to 5/17, or 21 weeks to annualize the year to date. They came up with $45,895, and then they added the bonuses to the stated income and came up with $46,279. So the anticipated income based on stated wages was a little higher. However, I reviewed a calendar and I ended up using 20 weeks for the year-to-date period based on 10 biweekly pay periods. I started with 12/23, checked the biweekly periods, and saw that the last pay period would have ended on 5/10, and perhaps it was paid out on 5/17. Using these 20 weeks instead of 21 increased the year-to-date calculation to $48,189, and it overqualified the household. Unfortunately, the resident had already moved out and management was unable to get further information, so I ended up having to issue an 8823 for an over-income household. So this just points out that you need to be very clear, and when there's a difference between what's written on the written verification and the phone clarification, you always want to make sure that you check out those differences and can fully explain them. So let's move on to an additional verification. And this one is one that was received at first recertification. This came in for this resident who moved in on 7/20/2018. The recert date is 7/1/2019, and that's when this verification was obtained. Jane Doe declared only receiving SSI income for her child on her REA, and the household vacated on 8/31/19. When I looked at this verification, I looked at that move-in date of 7/20/2018, and then I took a look at the first pay date on the verification, which says, and I'm sorry, I know this isn't the easiest verification to read, but when items are copied into files and then scanned to us, a lot of times as an auditor, this is exactly what we see. So sometimes we have to, look really closely at numbers. If I'm not sure if what year this is, a 2018 or a 2019, well, this tells me it's a 2018 total. So that, kind of helps clue me in. So when I looked at this, the earned period start date is 7/16/2018 to 7/31. So these look like bi-monthly pay periods. And I see that during that period, on the highest portion of the income, over $1,000 was earned. And then there's additional line items. When I compare that $1,000 earned to some of the other pay periods, and I see 1,120 being the amount for a full pay period, it leads me to believe that this person may have not started on 7/16, but they started either maybe slightly before or just after the 7/20 move-in date. So if they started before, obviously that's an issue. If they started just a couple days after, I would want to see when this person was actually offered this job. Because of course, if they had the job or if they had the offer of the job before they moved in, that should have been included in their move-in income. So I found this during a 2019 annual report review, which of course I complete the year after the annual report is turned in. So I completed the review in 2020. I asked for clarification on the start date, as this additional income would have overqualified the household at move-in. Unfortunately, management was unable to get further information because the resident had already moved out. An 8823 was issued on this initial qualifying household, as it could not be determined if the household qualified at move-in because we could not figure out the actual start date and when the job was offered. So this is a reminder that when you're looking at your first recertifications, you really need to not only complete your recertification file, but you need to take a look back at your move-in file and see if any of the information obtained at recert would somehow impact your move-in file to show that the household wasn't really income qualified at move-in. So let's look at another one of these from a first recertification. On this household, they moved in on April 20 of 2018. The recert date was 4/1/2019. And Kimberly signed a zero income certification at move-in, and the household was $12,945 under the income limit. When the verification came in for her recertification, the employer listed a start date of June 27, 2013, years before the household moved in and Kimberly signed a zero income certification. The verification also told us that from January 1, 2018 to the end of November, the household earned $25,417.62 from this job, and that was the year of their move-in. So when the property called and tried to get additional information, the employer again verified the first date of employment. And when they were asked, was this person working throughout the whole period, they disclosed that Kimberly was laid off for the duration of a location remodel. This employment was at a Taco Time and the store was closed down for a period for remodel. They said the location was closed from February 12th of 2018 until May 12th of 2018. And Kimberly's employment dates were her original date of hire in June of 2013, her termination date of February 12th, which matches the date that the restaurant was closed, and a rehire date of 5/12, which is exactly the date that the restaurant reopened. So I questioned that because when I saw it on a 2019 annual report review, again, that I reviewed in 2020, and I asked for clarification whether Kimberly was terminated or laid off, and if they held her job for her until the remodel was done, because she started the exact same day that the restaurant was reopened. Management, when they checked into this farther, received a letter from the employer that Kimberly was guaranteed her job back and she did not have to reapply. So an 8823 was issued on this initial qualifying household for failing to report all of their anticipated income, which would have made them over income at move-in. So again, this just points to the need to go back and clearly look at your move-in certification when you're processing your first annual recert and make sure that there's all the questions are answered, that there's nothing there that just does not add up.
Okay, now we're going to talk about work number income verifications. For those of you that aren't familiar, the Work Number is an online database used by several large employers to provide income verifications for a fee. Basically, these employers just outsource their income verifications. There are other companies that provide similar verifications. I believe InVerify is another similar agency, but you'll notice that I mostly refer to the Work Number. That's just because they're the most common, they're the biggest. But know that as I'm going through this, the same rules would apply to another verification agency such as InVerify. The fees associated with these verifications can be passed on to the resident, unless of course you have a HUD contract. Some examples of employers who use the Work Number are Alaska Airlines, Boeing, Delta, Fred Meyer, Starbucks, and Walmart. Because there is a fee associated with each Work Number verification, pay stubs can be used in lieu of an income verification. However, the Commission will only accept alternative verification after you've shown that you've tried to obtain third-party verification. Make sure you follow these steps when verifying income for an employee whose employer uses the Work Number. Step number 1 is to send the Commission's employment verification form to the applicant's employer. So you still need to send them a VOE. Step number 2 is to contact the employer by phone if they don't respond to the VOE. Or if they do respond to your request and they just refer you to the Work Number, you still need to call them and complete a phone clarification form. At the very least, you're trying to verify the applicant's first date of employment and confirm that the employer uses the Work Number for their verifications. Your next step is to obtain enough pay stubs to show wage activity for the past 3 months. So if they're paid monthly, you would only need 3 pay stubs. But if they're paid weekly, then you would obviously need more than that. From the pay stubs, you'll need to determine the applicant's current pay rate and year-to-date information. This is important. If the pay stubs don't give you enough information to determine the year-to-date wages, or if you weren't able to get the first date of employment from the employer, you're going to need to request a verification from the Work Number system or the other agency to calculate the year-to-date wages. Once you have both current and year-to-date wages, you would use the higher amount to determine the annual gross income for the applicant. And these steps can all be found in the tax credit FAQ section of our website, so you don't need to frantically write these all down. You can just go to our website and they're outlined there. One other important thing to remember when using the Work Number or another similar agency to verify income is that we highly recommend that you obtain at least one pay stub to compare the data provided on the verification printout. We found that the verifications aren't always up to date. They may not be complete. Sometimes the information is not correct. So it's always a good idea, even if you do run a Work Number verification, to still obtain at least one pay stub so you can compare it to the information on the verification and make sure everything looks correct. All right, so we're going to look at a sample Work Number verification now. This is page 1 of the verification. I've enlarged the employment section, and you can see that their employment status is active and that their most recent start date was August 10th, 2017. You want to make sure that you always review all of the information carefully and pay close attention to the employment status and their start date.
Now we're going to look at the second page of the Work Number verification. I've enlarged the upper part of the second page, and we can see the pay rate, the average number of hours per pay period, and the annual income summary. So we're able to see their hourly rate is $18.05. It doesn't show us the average number of hours per pay period. Sometimes the verifications will have its information. A lot of times they don't. That's okay. We still are going to be able to calculate their income. And then the annual income summary shows us the history of their annual earnings for each year that they've worked for this employer. So we have their 2019 annual earnings, their 2020 annual earnings, and then the current year, 2021, shows us their year-to-date earnings as of when the report was run. So in this situation, the 2021 year-to-date earnings are $7,388.05. The pay cycle is biweekly, which tells us there are 26 pay periods per year. To confirm when the year-to-date start period began, you can add up the gross earnings for the most recent pay periods until you get to the total year-to-date earnings. So in this situation, we totaled up the earnings for the most recent 5 pay periods until we got to $7,388.05. So that tells us that this was the first pay period of 2021. So to determine when that period started, we need to look at the prior pay period, and we can see the end date for that period was 12/19, which tells us that the first pay period for 2021 began on 12/20/2020. The year-to-date end date is a little bit easier. You can just look at the pay period end date shown here, which is February 27th, 2021. So we calculate the income by taking the year-to-date earnings of $7,388.05. We divide it by 10 weeks, which gives us $738.81 per week. 738.81 times 52 weeks gives us an annualized total of $38,418.12. All right, so we're still looking at the pay period history. And now we need to calculate their average income. So we're going to look at the total gross earnings for the most recent 6 pay periods to come up with an average. So here we've totaled up using all of the history for the most recent 6 pay periods. We've totaled it up and we come up with $8,848.60. We divide that by 6 to give us an average of $1,474.77 per pay period. Then we annualize that by multiplying it by 26 pay periods to come up with an average annual income of $38,344.02. One thing that's really important, though, is to make sure that you look at the full picture. So you need to review the entire pay history to ensure that the payments are consistent and there aren't any periods of higher earnings. So in this situation, if we look at the most recent 6 pay periods, the earnings are all fairly consistent between about $1,400 to, $1,500, $1,300, all kind of in that same range. But when you take a step back and you look at the full earnings history, you can see that there are some instances where they've received as much as $1,874, $1,878, $1,865. So there definitely have been a few pay periods where they've earned a little bit more than the average income that we've calculated here. So that can definitely impact your calculations. So it's important that you look at the big picture and address any discrepancies to make sure you're calculating their income correctly. Okay, so now we've completed our calculations. Based on the year-to-date earnings, we come up with an annualized income of $38,963.60. Using the most recent 6 pay periods, we come up with an annualized average income of $38,344.02. Okay, so we would just take the highest and put it on the LIHTC, right? We're done. Again, I want to remind you to look at the full picture. So if we take a look at the pay history, we want to make sure we look at the annual income for previous years. So in 2019, their income was $29,392. Okay, so that's fine. That's less than what we've calculated. But in 2020, they made $45,129.87. This is higher than what we've calculated now. I'm guessing that those pay periods we saw on the prior page with the higher earnings probably indicate that maybe there's a time of year that they're a little bit busier than others. They probably pick up a few extra hours, maybe work some overtime. That's probably what we're seeing here. So anytime you have a situation where the income in the prior year's history is higher than what you've calculated, we're going to need an explanation for the discrepancy. And if it is a situation where they happen to have a busy season where they work more hours, you're going to need to adjust your calculations to reflect that appropriately.
Now we're going to look at a real example of a verification that was received in a file we reviewed. There will be situations in which the work number does not provide enough information for you to calculate their income. When we look at the historical pay period summary in this example, we can see that it shows data is not provided. When we look at their most recent start date and the number of time they've been with the employer, we can see that they've only worked there for 4 months. So in this situation, we would need to request pay stubs as a backup. This is an example of an applicant who had just recently started this job, so the work number did not have enough information to provide the data. It just simply hadn't been put into the system yet. So the site requested 6 pay stubs. I know that these are impossible to read. I don't expect you to be able to read them. I've summarized them here. So when I added up the gross earnings for each pay stub, I came to a total of $9,917.93. When I divide that by 6 pay periods, I come up with an average amount of $1,652.99. I multiply that by 26, the number of pay periods, and I come up with an annual income of $42,977.74. But what do we see when we look at the pay history of these pay stubs? The income amounts for the pay stubs 4 through 6 are higher than the amounts for 1 through 3. So when I just focus in on those 3 pay stubs and I find the average per pay period amount, you can see that it's much higher than what we had calculated before. We come up with $1,856.88. When we annualize that, we come up with an annual amount of $48,278.88. So there's definitely a big difference there. In this situation, the resident's hours increased a few weeks after they had started working. At their first annual recertification, they were determined to be overqualified and an 8823 was issued. So it's really important to pay close attention to the payment history, make sure you look at the full picture, and watch out for instances of escalating income. There have been some exciting changes when it comes to verifying unemployment income. The Employment Security Department, ESD, has introduced a new online portal to request verification of unemployment benefits. Before you can start the online request, the resident or applicant will need to sign an authorization form. The authorization to release records individual form will replace the unemployment benefits verification form that was previously published on our website, and it can be found on the ESD website, which is linked here. When you're looking at the ESD website, you're going to want to go to the public records section, and when you're at that page, you're going to scroll to the bottom, and you're going to click on the third link that says authorization for a third party to obtain copies of an individual's records. This is the authorization to release records individual form. You're going to want to complete sections A, B, and C. Under the state purpose of disclosure section in part B, we recommend that you indicate the verification is needed for low-income housing. In section C of the form, you're going to want to select the second option to authorize the release of unemployment payment history. The date range should date back 2 years from the request date. Then the applicant or resident will need to sign and date the form. The request portal can be found in the public records section of the ESD website, which is linked here. Again, you're going to want to scroll to the bottom of the form to begin the online request. The first step of the online form is to upload the authorization form. So in section 1, you're going to click on Browse, and then you're going to upload the signed authorization to release records form that the applicant has signed. Once that's uploaded, you're going to click on Add Request, and this will open up a pop-up window. Enter the applicant or resident's information and specify the date range. So here we have our applicant's name, their social security number, and you need to enter the date range. Then click Save. Again, we recommend that you request 2 years of unemployment payment history. Once that's completed, step 3 of the form requires information about the requester. That's you. Enter your organization's information and specify how you would like the verification returned. If you're going to be having it sent via email, please make sure that your email is secure. Once the online form is complete, read and acknowledge the legal disclaimers and then click Submit.
We're going to go over a few samples of how to successfully verify gig income, which is self-employment. When calculating annual income, owners must include the net income from operation of a business or profession, including self-employment income. In gig economy, temporary, flexible jobs are commonplace, and companies tend to hire independent contractors and freelancers instead of full-time employees. People earn income providing on-demand work, services, or goods. Often it's through a digital platform like an app or a website. Some of the most common ones that we see are Uber, Lyft, Instacart, DoorDash, selling items on Etsy. These are all apps where the customer places their order and pay online, even the tip. There is no cash transaction. Well, how do we verify this income? Well, the applicant resident should complete a self-employment verification form. If the business has filed a tax return, they should submit their most recent signed one, which should include a Schedule C, D, and or F or K1. If they have more than one business, there will be a Schedule C for each one. For instance, quite a few people that drive for Uber also drive for Lyft. So in this instance, they would have 2 Schedule Cs. If they haven't been in business long enough to have filed a tax return, they should submit a profit and loss statement. If any questions arise while reviewing these documents, please request further documentation or clarification and make sure to note the file or attach any additional documentation that they give you. If this file is requested during an annual report submission, make sure this extra documentation or notes gets sent. To assist in determining their self-employment income, they can complete and submit a self-employment income worksheet. Always use the net income from the business. The business income should be 0 or greater. If the net income from a business is negative, it must be counted as 0. A negative amount must not be used to offset other household income. Now, let's look at an applicant's paperwork who is applying for housing on March 1st, 2021, and is self-employed. She's filled out the self-employment verification form. It's always good to look over the form and get familiar with what business they're in and their occupation. So this is Whitney, and she's self-employed with Uber, and she's a driver. Her business began on 3/1/2020, so it's been in business a year long. So that's long enough for her to have filed a tax return. Last year's income was $3,972. She was in business for 10 months. Her anticipated income for the following year is $10,000. Now, this looks like it's reasonable. It's more than it was last year, and last year's was only 9 months. She's been in business continuous for 12 months, and she's attached her tax return. So let's take a look at her tax return. Now, you're going to want to make sure that the tax return is signed. If it's not signed and they did it electronically, you want them to make sure to submit that paperwork. This is Whitney Hancock's current tax return. It's for 2020. All income and assets disclosed on this tax return must be accounted for on the REA. Now, it appears that she has a job, as there's income in line number 1. So you want to make sure that is on her REA. The self-employment income is located on line number 8. This amount should equal the net profit or loss on line 31 of the Schedule C. If it does not, then the resident may have had another business and should have another Schedule C. So let's take a look at her Schedule C. It's the current one for 2020. It's for Whitney Hancock. She's a driver, and it is for Uber. Her income is $12,722. So let's take a look at her expenses. She has $6,000 as rent or lease on a vehicle, machinery, or equipment. Well, that's reasonable. She drives a car for work. Let's look at a few other areas that you'll need to get clarification on if there's figures in these line items. For instance, who was paid the contract labor? The wages. If paid to the applicant, you'll need to have those added back into the net income. You'll also want to add back the depletion and depreciation back into the net as well. They're not approved deductions. So now let's take a closer look at other expenses, the $2,750. This can be found on page 2 of the Schedule C, line number 48. Again, you'll want to review the form, and if any questions arise, make sure to get those answered. So now we're going to look at Part 5, the other expenses. It appears she has $1,200 in cell phone expenses. I think that's reasonable, as she needs her phone for business. She also has $1,550 in gas. Well, she drives her car for her business, driving people around. So it appears these expenses are good. She filled out a self-employment income worksheet, which helps the residents figure out what self-employment income should be used. On her tax return, there isn't any expenses that need to be added back in. So it's just the net profit and loss from the Schedule C, line 31. Okay, so now let's take a look at an applicant's paperwork who is applying for housing on August 8th, 2020, and is self-employed as well. Again, let's look over the form and get familiar with the business they're in and occupation. So Whitney is self-employed through Instacart. She's a driver. Her business began on 5/22/2020, and she is self-employed. She's only been in business for 3 months, not long enough for a tax return, so she should have included a profit and loss statement. Last year's income was nothing. She wasn't in business last year. Her anticipated income for this year is $3,972. She's planning to be in business continuous for 12 months, and she's attached her recent profit and loss statement. So now let's take a look at her profit and loss statement. It's 3 pages long, and it's giving us the gross income, her expenses, and then gives the net income for each month. So she started her business in May of 2020. The gross income was $43.08. Well, looking quickly at the other gross incomes for the other months, they're all over $300. So I think if you used May's numbers, you would skew the numbers. So let's start calculating her income in June. So June, she made $394 gross. Her expenses were $20, so her net income was $374.17. And then we've got July. Her net was $312.79. August, $314.73. Well, since she hasn't been in business for a full year and her income will need to be annualized, she's guesstimating for September 2020 through May 2021. So it looks like she's going to be using $350 gross, $20 as the expense, making her net income for $330. Now looking back at June, July, and August, they're all over $300 and under $400. So I think this figure is reasonable. You're going to want to calculate June 2020 through May 2021, adding all the months' net income together. This makes her annual net income of $3,972, just like what she put on her self-employment certification. She's also attached the transaction histories for this time that she's been in business. So this one looks like a nice clean file. What if you were to receive these transaction history screenshots as backup for a self-employment applicant? How would you calculate this income? Well, it appears they started their Instacart business in November 2020, and they're applying in early January 2021. There's a weekly total for November 9th, 16th, and 23rd. Where's November 30th? Well, I see a partial print of customer tips of $20, but this isn't from December 7th. It appears that November 30th was cut off. You'll want to get verification of this missing week. To figure out their income, would you add all the weeks together and add back in the insulated bag purchase to be able to get the income? Well, that would be a total of $522.30 for 6 weeks. You would then divide the $522.30 by 6 to get the weekly amount of $97.66. We would then need to take the weekly amount of $97.66 and times it by 52 to get the annual income, and that would be $5,078.32. But to be more conservative, how about calculating November's? They're the highest and most consecutive. We would take the 3 weeks that we have and add them together, which equal $458.66. You would then divide the $458.66 by 3 to make a weekly income amount of $152.89. We would then need to take the weekly amount of $152.89 and times it times 52 to get the annual amount, which would be $7,950.28. Well, you know, the income amount of the 3 weeks in November is almost $3,000 more than the 6 weeks combined. I just don't think there's enough information to correctly calculate their income. More information is going to be needed. Let's look at how to verify an annuity. The applicant resident would need to fill out the top portion of the annuity, stock verification, or 401k account form. This is for Elizabeth Miller. She has an annuity through Legacy Annuity and Life Company. The form would be sent to them for verification. So as we can see, John Hancock has filled out the form and has signed it. So let's review it. The market value of her annuity is $5,727.73. The annual dividends or current annual yield on this is $1,241.31. She's not getting any distributions and she doesn't have access to the funds. So how would you count this on the HEC? This would be counted as an asset. You'd fill out page 3, part 11 of the HEC with her name. Type of asset would be an annuity. The year-to-date income is $1,241.31. This would come from the annual dividends or current annual yield from the form. The current balance market value is the market value from the form. $5,727.73. The actual income year-to-date annualized is the year-to-date income from the form. And the cash value is the market value. So this is a pretty straightforward asset verification. So let's take a look at another annuity. Again, this is for Elizabeth Miller. She has her annuity through Legacy Annuity and Life. The form has already been completed. So let's review. The market value of her annuity is $9,941.43. The annual dividends or current annual yield is $831.62. She's not getting a mandatory distribution. She's getting a non-mandatory distribution of $112. The frequency of the distribution is monthly. So she's getting annual dividends or current annual yield and distributions. We will need to find out which one is more. So take the distributions and times them by how frequently she gets it. So in this case, it's monthly. So we would take 112 times 12, which equals $1,344. Since the distributions are more than the annual dividends or current annual yield and paid monthly, this annuity would be considered income. So on the HEC, the income section, part 10, would be filled out. Make sure to put the resident's name. The type of income would be annuity. The pay frequency is monthly. The pay rate is 112. Months per year is 12. And the annual income is $1,344. Since this is considered income, the annuity does not get put into the asset area 2, as this would be double counting. So as you can see, there's a little more calculating that needs to be done on this annuity. So if the distribution would have been annually, meaning one time, this would be considered an asset and the income would not be counted. So I have a challenge for you. If it was an asset, please type in the chat what the year-to-date income would be, and the first right answer will get mailed a prize from us. Good luck.
Now let's take a look at some deposit verification requests to see what would you count. And that means what would you count as the balance for the asset and what would you count for earnings on the asset. This verification is one that came back from a bank and they've completed the section verifying all of the assets. So I'm just going to take that section and blow it up so it's a little bit easier for everyone to see. And we can see on here that there is an average balance listed for a checking account. The checking account is the only account where we want to use the average 6-month balance. All other accounts, we generally want to use the current balance on the account. And we got those for both the savings and the CD account. We were also provided with interest rates on all of these accounts. So let's take a look and see what we would show on our housing eligibility certification, or our HEC. This is on page 3 where you show your calculations. First thing we're going to do is put in those interest rates from our verification. Sometimes you won't have an interest rate and you may need to rely on year-to-date income so that you can annualize that. That would typically be on a stock verification form or maybe an annuity verification form where you would get year-to-date income. But in most cases, if there's an interest rate listed, that's what you want to use to calculate the actual income from the asset. Next, we're just going to take and put in those balances that we chose that we're going to use as the market value or the current balance on the account. Then to get to the actual income, what we're going to do is we're just going to take those interest rates, multiply them by the current balance to figure out how much we would expect the resident to earn on those accounts over the next 12 months. For fees to convert to cash, typically we're not going to have an entry here unless we have a large account that would have substantial fees to convert it to cash. Real estate, for example, if someone owns a home that they're selling and they owe a mortgage and there's going to be closing costs, let's say, that's where you would want to enter the fees to convert to cash. And then you would take the current balance of the account less the fees to convert it to cash to come up with a cash value. We're always going to use the current balance times the interest rate to get the actual income earned. However, the cash value is going to come into play if total household assets are over $5,000, and we're going to use an imputed interest rate to calculate the possible earnings on accounts. So for the most part, probably won't have fees to convert to cash, and your cash value will be the same as your market value or your current balance as you're seeing in this instance. Take a look at another one, and this one is a Wells Fargo verification. There are some banks that, just will not complete a deposit verification. So this is Wells Fargo's form, and we're going to look at this one as what would you count for a January 1, 2021 certification, as this is an October 2020 statement. They've provided the type of account, a checking, a current balance on that checking, and an interest rate. They've also given the average balance for the last 6 statements. There's also a savings account with a current balance, an interest rate, and they've also provided the average balance on the last 6 statements. So just as we did in the prior example, when it comes to checking, we're going to want to take the average 6-month balance. So I've just taken all of those average balances for the 6 months, averaged them out, and then I'm going to use that 0.01% interest rate and calculate annual earnings on this account of 11 cents. Then when we look at the savings, again, here we're going to take the current balance. We're going to take the interest rate, which is also 0.01%. So we have a value of $323.85 and 3 cents of earning on that account. And just like in the prior example, you would fill that in on our HEC on page 3 and show those calculations. What could possibly need clarification on this file? If we look closely at the savings account, we'll see that there was a $300 balances and then a rather large deposit to bring it up to over $29,000, then dropped to $13,000. So that was a $16,000 reduction. And then from the $13,000 dropped all the way down to $62. So basically it looks like that $29,000 was put into the account. It went back out of the account. A lot of times you can look at other accounts to see if you see that fluctuation. So for example, we can look up at the checking account and see if maybe that money was transferred from savings to checking. But I'm not seeing that in this example. So a good question here to ask the resident is, where did the money come from? Where did the money in the account go? And the reason we would do that is we might be looking for, did they dispose of an asset for less than fair market value? So asking the resident to explain that, give you a written signed statement to add to the file, that would just add clarity. So that brings us to the end of our examples that we're going to look at. We want to encourage you can always call or email your portfolio analyst if you want to find out who that person is and how you contact them. If you look on our website, this is on our compliance tab. In the Contact Us area, there is a general division email that I've just starred down here at the bottom. But we really recommend that if you have a question specific to a property, you ask the portfolio analyst for that property. And you can find out who that is by clicking on this link. That will pull up this PDF file. And notice all of our names are listed here, our direct phone numbers. Although at this point in time, since we're not in the office, our phones will forward, but it's probably best to try to reach us by email. And so typically it's our first name, period, last name, and then you add wshfc.org after our name. And just notice that Michael Dill uses his middle initial, so his setup is a little different. Okay, and that is how you can reach us. And we're always available for questions, and we are available for questions right now. Dwayne is just going to switch us over from sharing our screen with you to video mode, and we're going to look in that chat and start answering any questions that you have posted for us.